Welcome back. I'm Jeremy Szafron. Wall Street's record run is showing its first signs of fatigue. The S&P 500 is hovering near 68.25, just off all-time highs after a $17 trillion surge in global equities since April. Now, tech continues to dominate. Amazon up double digits on cloud growth. Apple steady. And Nvidia now the first company in history to top a $5 trillion market cap. But that narrow leadership is raising new alarms. Michael Burry, the investor from The Big Short, just warned in a tweet that sometimes we see bubbles. He was posting that on X cryptically as megacap valuations stretch to these extremes. Now, the S&P 500 now trades around 23 times forward earnings. Tech megacaps over 31 times, and yet Wall Street isn't backing off. That Bank of America report showed $17 billion in new equity inflows this week, with strategists saying AI leadership isn't budging. And meanwhile, gold is under pressure, down nearly 1%, just under $4,000 an ounce on the spot side as the dollar strengthens and traders question how much longer this rally can last. So that's the crossroads here. Optimism in tech, anxiety in metals, and a market wondering what breaks first. And that's exactly why Gareth Soloway is here, Chief Market Strategist at VerifiedInvesting.com, to show us what the charts are saying right now. You've been so accurate this year. Great to have you back. Let's dig in here. Good to see you, Gareth.
Good to see you too, Jeremy. Thanks for having me.
Listen, man, we were talking about it a little bit there. It's been an interesting year. I mean, this whole week has been an interesting news flow. But that S&P having that historic 7-month streak, nearly 40% off the April lows. And then we get the NASDAQ 100 just logged its longest winning run in 8 years. On your S&P chart, are we nearing exhaustion? I mean, does this technical setup still allow another melt up into the year end? What are your thoughts?
Yeah, so what we have here is the S&P daily chart. And, again, I look at charts. I'm a probability trader. And one of the things that we're starting to see is the exhaustion sign. And one of the most remarkable charts here and factors is if we flip to the weekly chart, and I'm a trend line junkie, so I use trend lines and parallels, and they help guide me, right? And so what we're going to do here is we're going to take the low from 2020, which was the COVID low, and we take a trend line and drag it through the bear market low of 2022 all the way up through the liberation sell-off lows. And look at how all of those lines connect perfectly. Those low pivots are all right there. And then what we do is we drag a parallel. What would be the most logical place to go? Go to your bull market high of 2021 right here and look at where we just hit. And so as a technician, I look at this and I say, all right, so we know that when we are down at the lows, these are great buying opportunities, right? Even this one in here in 2023. But then if we're at the highs, like in 2021, this tends to be a sell signal. And so for me, I say, holy cow, we possibly just put in a major top on the market with the potential to see a drawdown, possibly as high, as low as around 5,400 on the S&P. And I know that's shocking to most people. Everyone's in the vibe right now that, the markets can never go down. But I would just like to point out that when you hit key milestones, for instance, Nvidia hit 5 trillion. You mentioned it. Apple hit 4 trillion this week. These are key milestones that oftentimes mark tops historically. People need to be aware.
Yeah, be aware. And, at the same time, of course, we see these earnings. They've been strong, right? I mean, more than 60% of the S&P companies have beaten these expectations. If the fundamentals are this solid, we got to ask, I mean, are bears fighting the tape here? How do we reconcile that caution? I mean, we see those lines, so it's actually probably time for a little bit of a haircut.
Yeah, I think a little bit of a haircut at minimum. We haven't had a bigger than 3% drawdown basically since the liberation sell-off in April. But I also think there's some other concerning factors here. We talk about how can it be a bubble? These companies are profitable. And the answer is yes, they are. That's true. But in all fairness, Cisco back in 2000 was also profitable. It was pets.com, these little mini.com companies that weren't. And there's a ton of those out there right now in this environment. And one interesting stat, and I heard this and I said, holy cow, that's incredible. In 2000, Cisco's market cap was equal to 3.9% of the US GDP. So again, 3.9%. Nvidia's market cap alone is equal to 16% of the GDP in the US. Now, is that normal or is that a bubble? I tend to look at the bubble side of things when things get that overinflated.
Yeah. I want to continue to talk about that AI trade because we've been talking about it almost all year. It's not stopping, but we can't ignore seasonality. I mean, we know November, December, historically the strongest 2 months for equities. Could that override the resistance picture, at least temporary?
Yeah, so it certainly could. And I do think, I think if we're going to get a correction into year end, it needs to be in November because
Mhm.
once you get into December, that seasonality and these fund managers that find out that, oh my goodness, I'm lagging the returns in the NASDAQ and the S&P, they have to just start buying. Even if they don't want to buy, they have to play catch up and they're going to buy in. So for me, at least, November is kind of this zone of where if we're going to get some sort of pullback, we get it. And then I think you probably get a bounce into the end of the year before next year seeing a larger correction.
Okay, I mean, Nvidia is now worth more than the GDP of Japan. I mean, we got Amazon, Meta, the Cloudflare. They're all reporting major AI-related growth. But then we got this Michael Burry saying it's a bubble. I mean, again, you just talked about the 90s .com period, those pet.com days. What's similar? Just break it down a little bit more. What's similar and what's fundamentally different this time around?
Yeah, so the similarities, right? You have a lot of the same psychology, and psychology drives the market, right? People think, when you look at a chart, it's arbitrary whether it goes up or down. It doesn't make any sense. But in reality, as we saw with the S&P, every drop, as scary as it was, it aligned perfectly with a trend line going back to the COVID lows. So there is order within this chaos. And that same psychology of greed, the markets will never go down. Oh, the Fed will always save us. The government will always print more money and spend more money. That's the same sort of mentality that in many ways we saw in the dot-com bubble about feeling like the markets would never go down. And those are huge concerns. I mean, you have, again, not just the Nvidias of the world, which they make a ton of money, but then it's the trickle-down effect. And then when you look at things like this stat here, 75% of the upside in the S&P in the last 2 years is only due to the AI stocks. So what's happening to the rest of the market? And then other stats like this, right, where you have people that are making under 200,000 are struggling. And we heard from CMG this week. In fact, if you guys can take a look, we can take a look at the chart on CMG here. Look at the drop on Chipotle. And Chipotle clearly came out and said, guys, the generation Z, Y, the generation, all these millennials, they are not able to afford even going out to Chipotle anymore and buying burritos essentially like they were. And, people that are making more than 200K, these are the people that have lots of investments. The stock market's been going up, so they're feeling fine. But a huge majority, like 70% of the US population, maybe even 80%, is struggling like they're in a recession. And I really do think we have this K-shaped recovery, if you will, or K-shaped economy where you have the people that have investments. The stock market's been going up massively. They're doing great. But everyone else is really struggling, and it's just a matter of time before the stock market stalls, and then those people at the top stop spending, and that's when we see that recession hit.
Yeah, you bring up that Chipotle. I was watching that coverage too. I mean, it's interesting. Could it be that if the broader market keeps rallying, as we're seeing with AI and tech flows, that this kind of value play will outperform despite the current headwinds here?
I do think value plays are the key, right? And again, we've seen such a condensation, so much focus on the AI names where they've been sucking in this money over and over again. So if someone puts $1 in the market, we're seeing a massive amount of that money go into the Magnificent Seven, the AI play like Nvidia. But I do think there's an opportunity here where you see stocks that are kind of the have-nots that have been underperforming, the Pfizers of the world, the Novo Nordisk, the stuff like that's trading at multi-year lows that pays a dividend. Those are the ones where I actually look at it and say, okay, these could be the next play. Just to show a chart here, guys, take a look at this one. This is Pfizer. Now, Pfizer has underperformed for a long period of time. I mean, you go back, it's even trading below the COVID lows currently. Right? I mean, here's the COVID low when everyone thought the end was near. And then obviously Pfizer had that incredible run because they came up with the vaccine or one of the vaccines. But look at where it's trading. This pays a 7% dividend. Now, with interest rates going down, I'm thinking to myself, okay, money flow. Remember, hedge funds don't like to pull money out of the market because they don't make any money if the money's not in the market. They get 20% of profits, so they need to have that exposure. So they're not going to probably pull money out of the market until all out panic hits. But what they're going to do is look for these forsaken plays that pay high dividends to stash money. And look at this beautiful trend line right here. You have Pfizer right at the low end here. I would look for this to go up to like 27.50 and even break out above that, all along collecting a 7% annual dividend. At least that's where I'm positioning my own capital at this time.
Yeah, interesting. Well, you and I chatted just briefly about gold. I mean, I just want to go there for a minute. We'll come back to AI because obviously you saw that, speaking of haircuts, I mean, you saw that little dip, right? It went down nearly 1% just today, about 39.83 at the time that we taped this, but it peaked at 4,300 earlier this month, and you called the pullback almost to the day. I mean, what's the chart telling you right now? Are we still looking for that, 3,500, 3,600 accumulation zone? Are we kind of solid here at 4,000?
Yeah, so I am still looking for a bigger pullback. It's been a nice pullback thus far, but I'll show this chart here. This is an absolutely remarkable chart, how the similarities with 1979 and the price action. So this is the chart here in 2025, and you can see here's in 1979. And this had this beautiful move up, and over here in 2025, we had this nice move up. In 79, we had this sideways consolidation. We had the sideways consolidation in 2025. And then after that, we had 9 straight up weeks in a row in 1979, which led, look at this, to a big top in gold and a pullback. And what's interesting here is when we pulled back, where did we go? We went back to this general zone right here, which was the previous major high before that consolidation. Well, look over here. In 2025, 9 straight up weeks. So exactly the amount of weeks that we saw in 1979. And we've now started to correct. And really what I'm saying here is that while I think that this time is slightly different, and I'll go over that in a second, do we expect the pullback to take us? Basically back to that former high pivot right here, just like in 1979, we pulled back there. This is where I start loading the boat on gold. Now, quickly, let's talk about why this is different, because I do think it's important to say that, hey, listen, things aren't the same as 1979. For instance, in 1979, Volcker was raising interest rates. We had like 15, 16, 17, 18% interest rates in the US. Here, we're seeing Jerome Powell lower interest rates. Back then, GDP to debt to GDP was 32%. We're now at 130%. The government back in 79, 80, they were more apt to be negotiating and actually maybe not spend so crazy. In 2025, yes, we're in a government shutdown, which I think ends soon, and then the spending will start up again. So while 79 into 80 marked a multi-decade top in gold, I think this pullback is a huge buying opportunity for gold, where if we get that $3,500, $3,600 level, I do think we see 5,000 in 2026 as a price target.
Wow. Okay. So if gold is already paralleling that 1979, and we accept that risk exists, but also huge upside remains. I mean, I guess we'll see that dip. Worst case, we get that pullback, and then best case is a dramatic surge.
Yeah, I think that's really what I'm thinking, is that I don't see any, we heard about Doge early in the year, about Elon Musk stopping all this spending. That petered out so fast, it's honestly a little laughable. And so the government is going to go back to what it does best, which is, apparently during expansionary periods, spend a ton of money. Now, what happens when the economy slows and they're actually supposed to stimulate? Then they'll probably spend even more. So you have this fiat currency issue with de-dollarization, all these aspects coming in where other countries are now starting to question the validity of the U.S. financial system because of the debt, because of the inability of Congress to get spending under control. And that inevitably is going to make this pullback much shorter in duration than what we saw in the 70s, 80s, and even into the 90s before new all-time highs are hit.
Okay, so I mean, if you're right and that correction comes to 3,500, 36, that might look like weakness, but for long-term holders, I guess it's a setup, right? I mean, they're buying the dip. So you're preparing you're saying this pullback's the opportunity, not just a poke in the eye.
Yes. And the thing is, because a lot of investors piled on at the end of the run, it's going to be painful for a lot of people. And a lot of people may throw in the towel. I call them the weak hands, the people that bought at 4,000 or 4,300, where it was like, oh, gold can never go down, right? And we're now seeing that in the stock market, right? That same mentality just before probably a flush. And so oftentimes at the end of moves, the euphoria sets in, the FOMO sets in, people jump in just thinking, oh, it's the easiest trade in the world, just go long gold. The market has this weird way of flushing those people out, of getting rid of the weak hands, and then the strong survive, right? The strong still hang in there. The strong have been accumulating for years, and then price starts to move back up and hit new all-time highs.
What about silver? I mean, you look at that, Gareth. I mean, it's lagged even more sharply. It's down double digits from its highs. But, I mean, are these corrections kind of healthy resets? Or are they early warnings that investors are losing faith in the inflation trade kind of thing?
Yeah, I think more than anything, when you have vertical moves in silver, gold, or really anything, it just sets up for a natural correction, right? This is going back to the psychology that we've kind of talked about in markets. And it doesn't matter if it's crypto, if it's stocks, if it's commodities, human nature is human nature. We get greedy and then we get fearful and then we get greedy again. And it swings like a pendulum back and forth. And what's so cool about this chart on silver is we can look at this. Here's a parallel. So these lines are exactly parallel.
Mhm.
The low in 2008, the financial crisis here, that was that low. We connect that low to the low in COVID, the lowest point, and then we simply just take a trend line, a parallel, and drag it up to the high of 2011 and look at where silver stopped going up to a T right at that level. And so this to me as a chart signal allowed me to say, okay, the likelihood is we're going to get a pullback in silver. Now, the bigger question is how much of a pullback, right? And to do that, we need to go into a shorter term time frame. So I'm flipping over from the monthly chart to the daily chart. And what I'm really looking for is you can see this trend line right here, how it connects beautifully right through this area. And so I'm looking for a pullback to about $43, and then I'm going to start to accumulate silver. Now, keep in mind, I'm not going all in at 43 because I always worry that there could be additional downside, but at least that's a point where I can start saying, okay, I feel comfortable about getting in silver. And then silver longer term, I have the general same view that if the US and the world continues to just print our way out of disasters, of financial kind of mismanagement, then inevitably silver longer term goes up. The only thing with silver, be a little bit more careful because it's more apt to be adjustable to economic factors. We know it's an industrial metal as well. And I do just caution people that the volatility could be much bigger in terms of swings than gold.
Yeah, okay. So $43. I mean, could it be like gold a little bit? Could we see that big swing like the 45?
I do think so. I do
Yeah.
think so. And I think, again, the metals overall have been in slumber for so long that when we get this move to the upside, I believe it's closer to the beginning of the move than the end of the move. It's just people just have to understand that when something goes up, like silver went up from April of $26 to 54. I mean, that historically is one of the biggest near-term moves we've seen in silver and the gold move alike. You're going to have flushouts. You're going to have retracements. The key is you look to buy key technical levels on those retracements for those next legs to the upside.
Yeah, Bitcoin has been, still holding above 100,000, roughly 109,000 today, even after that pullback from the summer highs. Most expected a deeper correction, especially with ETF inflows really slowing here. I mean, does this resilience surprise you? Does the chart tell you we're closer to exhaustion than a breakout?
I am concerned about Bitcoin, and I'll tell you why. So the stock market, and this is a daily chart of Bitcoin, but the stock market has basically been hitting new all-time highs almost daily here over the last couple of weeks. And Bitcoin, we have a very clear top here that was put in October, early October. So about 3 weeks ago, 4 weeks ago now. And it's very concerning that a risk asset like Bitcoin is not seeing more upside in a market where the stock market just keeps going up and up and up. Now, one of the interesting things about this is that historically in 2017, Bitcoin topped out. And then 4 to 6 weeks later, the stock market topped out and had a big correction. In 2021, Bitcoin tops out in November. In December, late December, the stock market topped out and the bear market began. So I also am worried that Bitcoin is sending us a signal here. Now, going back to this chart, I got to show you this one trend line that has allowed me to not get irrational on Bitcoin's upside. And I love Bitcoin long term, but I'm also a trader, right? So I'm looking for pivot points where it's going to pull back. And look at this trend line. So just to give you guys a sense, this is your bull market 2017 high. This is your bull market 2021 high. And look at how Bitcoin has hit the line, and every time it hits the line, it gets rejected. And so while a lot of influencers out there call for like 200,000, I mean, heck, Michael Saylor, some of these other players are calling for like $1 million Bitcoin in a short amount of time. I am just a technician, and I say, listen, we got to take out this line first. This line has stood the test of time since 2017. Until we take that out, that's my top on Bitcoin. And I would expect downside until we take that out.
I mean, it's the counter would be obviously people would say, we're seeing global liquidity expand again, stable coin supply kind of climbing, and the risk appetite, it seems like it's kind of off the charts. Could Bitcoin actually be setting up for a second leg, melt up just like gold in 79, like one last euphoric run before reality hits, or what are your thoughts?
So that's definitely a possibility, and I do think that. Listen, like I said, I'm a huge longer term bull
Yeah.
because I have so, and unfortunately, so much. I have so little respect for the financial system in the U.S. At least the direction that we're going at this point. That how do you not like something that has a max 21 million coins in it, right? Same thing with gold. It's a precious metal. It's not easy to mine. So there's a limited supply every year of gold that comes out. But at the same time, what concerns me here is we see historically that when the stock market does correct and has a 20, 30, 40, 50% correction, that Bitcoin also corrects. And so for me, at least with the trend line we just discussed, I have to take the underbelly of that with a down move coming more likely than the upside unless we take out that trend line at 127,000. We get above that, it's clear sailing. There's really no major resistance there. But until then, I'm going with the stock market's close to a correction here, and therefore Bitcoin will likely fall. And Bitcoin, again, I think is a leading indicator of that scenario.
Yeah, yeah. And you brought up the macro environment there. I mean, let's talk about it just for a second. I mean, the Fed's latest cut came with dissent. Kansas City Fed President Schmidt warned inflation could stay stickier near 3%. I mean, Powell downplayed a December cut, yet the markets are still pricing more easing. I mean, on your charts, particularly the dollar index, are we looking at a base forming, just a bounce? I mean, the DXY has been holding near, its best month since July. Does that spell more pressure on commodities? What are your thoughts?
Yeah, and you're right. I mean, so it was definitely a hawkish cut by Jerome Powell in the latest meeting. But I think part of the market, right? I mean, we did see yields go up. The dollar has rallied. Here's your weekly chart on the dollar. So we really have seen a little bit of a bottom on the dollar form. But notice how it's coming off of this massive, massive decline. In fact, one of the worst periods in the dollar is 2025 until this recent little move to the upside. Now, what's interesting about this, right, is that if we look at this trend line, there's a trend line here on the dollar that actually gave us this low. And look at this. Look at how these lows connect perfectly going back to 2014. You could arguably stretch it out even further than that to the low in 2021. And then this is where we're bouncing now. And so for me, I look at the dollar and I say, unfortunately, there's limited upside here, right? If we look at this zone on this, and let me just grab a tool here so I can draw this in, we can see that this area was support. And I'll show you here. Let me draw on this here. So we came down, we hit it, we hit this line. There was this zone over and over again, and then we broke. And now it's become resistance. And so ultimately, even though the dollar is showing strength right now, I would actually anticipate a rejection of this zone here, and the dollar breaks down significantly with a downside target in the 89s on the DXY. And so I am bearish on the dollar, which again kind of goes to the macro view that while gold could pull back in the near term, it makes sense that if the dollar is going to eventually break lower, gold likely is going higher. And same thing ultimately with Bitcoin. If Bitcoin breaks down, let's say there's a stock market sell, eventually Bitcoin does make new all-time highs down the line.
Yeah, interesting. Garrett, have you looked at oil today? Anything on WTI? And the only reason I ask is we get this latest news out. President Trump denying reports of a Venezuela strike. Oil is still hovering around 61 a barrel, I think. But I've been talking to some people that think that there's some momentum. There's a way to trade this whole oil spike.
Yeah, and this is an interesting one because I would say number one is an economic indicator. The fact that oil is trading near 52-week lows is not a great signal for an economy that we keep on hearing is still hanging in there. The consumer is still spending over and over again. So number one, we did hit a support level on oil right here. You can see these lows align perfectly on the chart. And near term, what we have here is what's called an inverse head and shoulders, right? So we have this little pattern here. Inverse head and shoulders are bullish patterns. And so in the near term, oil could be setting up for some sort of move to the upside. But I would caution that the bigger macro, if we zoom out on this, this to me is a bigger macro bearish pattern. And I think copper, honestly, I know we didn't touch on copper here, but let me bring it up. Copper to me is also very concerning. Copper has bounced, but look at how it's inside of this big down move. This is what we refer to as a bear flag. Notice how it's an upside down flag, right? So bear and bull flags, just to do a quick educational piece, a bull flag would be a big move up with sideways consolidation, like a flag, like you have like your little flag there. This here is the flagpole upside down, and all of this is inside bearish consolidation. And so while the near-term oil looks bullish and copper is doing okay here, the bigger picture, let's say 3-6 months out, are for both charts to break lower, and that to me is also a warning sign for the economy.
That's interesting. What are your thoughts on this whole critical minerals, this metals play? And we're seeing these President Xi negotiations and what have you. I mean, some of these miners and what have you have kind of taken a little bit of a breath here with the metal prices, but is there still something to be said about these critical minerals?
Yeah, so names like Kamiko, right? I mean,
Yeah.
Kamiko's had such an incredible run to the upside for the uranium play. I do think that once these pull back, they're good buying opportunities. Here's the Kamiko chart here on the daily. You could see what an incredible rally. I mean, to just put in perspective, Kamiko in April was trading around $34. It just topped out up 212% at $75. So you have to let these things backfill just like gold, like silver. When things get too extended, think about it like it's a kid going off to the university. They come back for Thanksgiving or for Christmas to home base. Markets and charts do the same thing. It's like a rubber band getting stretched. At some point, it snaps back a little bit. And that's what we're going to likely see. But I do think the mineral trade continues to be a big one. I just can't pay up at these levels. I've got to be patient and wait for a pullback.
Yeah, yeah. Okay, let's end with a quick little lightning round. I mean, Bitcoin, we already talked about it. I know it's around 109, but I didn't hear you. I mean, are you buying the dip? Are you taking profits? What's the point to re-enter here?
Yeah, that's a great question. Let's take a look at the chart and see what we have here. So I already have my re-entry level on Bitcoin established. And for me, the first area where I'm going to start accumulating, there's this beautiful upsloping trend line right here, connecting basically the beginning of the bull market lows back in October of 2023 through the lows here in September of 2024 to the low here in April, which coincided obviously with the stock market collapse. And this level is right around 93,000. And so my guess is into year end, we see a dump out in Bitcoin, maybe even in November down to about 93 or so. And at that point, I start inching in just a little bit on Bitcoin.
All right, Palantir, because what a stock. I mean, it's near what, $200, up about 68% in 6 months. Is it momentum? Is it just mania?
I think it's mania. Okay. I hate to say it, but listen, the valuation, you're now talking in terms of literally X times revenue, not even earnings, X time, like literally 100 times revenue or 80 times revenue. Palantir is a fantastic company, but you could show me the best company in the world at a certain valuation. I'm just stepping back from it. Same thing with Robinhood. It's a hyped up play. It shouldn't be where it is. It will have a big correction. So with Palantir today, we're seeing a reversal with the markets, possibly a topping tail in here. I take the under. I think this thing is going to have a pullback. I'll show you the level here. I would be looking for a pullback in the near term back to about 175. So about a $25 drop here over the next couple weeks in Palantir. And then if it breaks this trend line, that's where trouble really starts. And if we got a bigger correction in the market, it probably would. If we get your run of the mill 3 to 5%, I think market on the S&P, it pulls back to this 175 level. If we start doing the 10% correction, that's where, again, we could see a retrace all the way back to $150 to $125. Wow. That's where I would start nibbling a little bit. Again, I just can't pay up for this stuff. We talked about Michael Burry. He made some great quotes recently. He obviously is known from The Big Short and for calling the market top. He's seeing the same things that I do, and it is a cautionary tale for investors. Remember, when the music stops, markets correct. Look at 07 into 08. Look at 99 into 2000. The euphoria is palpable. It gets you so riled up, especially with social media today. It gets you so pumped up because you think, oh, everyone else is making a fortune. And then you get long and it coaxes you long just before a collapse. Just be careful out there, folks. You will get a pullback at some point and then we can buy.
Yeah, and we always say the same thing at the end of it, right? Oh, we should have sold. We should have taken a little bit of profit. Okay, we've heard throughout the year, I mean, Amazon's really underperformed compared to some of these competitors. I mean, it's got this cloud breakout. I mean, we're hearing this new revenue. Is there still room to run?
Yeah, so Amazon's an interesting chart. Great gap up on earnings. You could arguably saying this is one of the few that hasn't performed with the Magnificent Seven. In fact, if we look here, going back to February until today, that had been its highest point on the chart. And so again, it's kind of playing a little catch up, but my bigger concern is a trend line that takes you back to the highs from 2021. So your bull market high, we connect that through that secondary high, the all-time high in January that was put into February here, and look at where we are. So to me, there's very limited upside. In fact, after hours, Amazon actually tagged this level at 254 to 255. I would be more cautionary here. Upside is limited, so you could get a little bit. But for me, it's more looking for a back and fill back to the gap fill down here. And by the way, just to bring up Apple as well, this is a really scary chart. Now, Apple's been one of the great performers. We're hearing about how amazing the iPhone, I think 17 sales are going here. But look at where it is on the chart. All right, if you connect all these lows from COVID, bear market of 2020, April 2020 liberation sell-off, and bring it to the bull market, here's where tariffs kind of started to come into the picture and the collapse. Look at where we are on Apple. We're literally nearing the end of a potential major parallel channel hit. And to me, I just use data to make decisions. I don't go with my gut, my emotion. To be honest, anytime I trade with emotion, I'm usually wrong. So I have to just rely on the charts. And if the charts are saying, be careful here, you're up into a major parallel trend line, I step back and I say, you know what, I'll either short it or I'll just stay on the sidelines.
Yeah, yeah. And I've heard some of your analysis. You've noted, right, Apple's repositioning into AI and services, yet the services growth, while strong, it's already priced in pretty heavily. And then we talk about those parts of hardware is lagging, like the iPads and wearables. I know that the iPhone is up on the sales, but the macro risks are rising. What must happen on your technical levels for Apple to remain a lead tech story rather than kind of a defensive large cap that's plateauing?
Yeah, and isn't that interesting how, earlier this year when the stock market would sell off, Apple would go up, right? It was a defensive. Money would rotate into Apple as a defensive. And now all of a sudden it's the new AI story, it's the new iPhone story, and it's now running higher. Interesting, by the way, it gapped up on earnings today and it's gone actually negative on the day. I don't know where it'll close today, but the idea here is that we're seeing a market where institutional money is starting to come in and sell. And I just want to show this chart because this is just a great example here. So if we look at this chart, this is Oracle, right? So Oracle, let me go to the daily chart. Remember, they reported these unbelievable earnings and this massive backlog of like almost, $600 billion. And that literally, that day was the top on the stock. And since then, it has done nothing but chop and go down to the downside. And again, we've even seen this on Microsoft. Remember last earnings, it gapped up and it fell, right? And these are telltale signals that while investors like retail are excited about these headlines, the media talks about it, we talk about it, they get very exuberant. Institutional money, who do you think selling these highs? Do you think, John Q. Public's like, oh man, they had really good numbers, I better sell into it? No way. What's happening here is institutional money, big boys like BlackRock, these players are the ones that are dumping into this euphoria. They know what's coming. They're thinking with logic. They're doing their models. They have their algorithms. They know that things are overdone and we're due for a correction, and they're taking money off the table into the retail irrational exuberance.
Yeah, sounds like a big promoter selling into that liquidity, don't you think? I got to ask you, finally, after this $17 trillion run, where are we emotionally? Maximum greed, or are investors still doubting the rally enough for it to keep climbing? Where are we?
Yeah, I would put us at the extreme greed side at this point, to the point where if you think about going back to COVID, every drop in the market has seen a V-shaped recovery after it. Within a month or so, we've been back to all-time highs. And what that does from a psychological perspective, and think about all the new investors that have entered the market since COVID. The younger generations are now fully involved. The younger generations are on Robinhood. They have their apps out. They're buying all this. They've never experienced a long-term bear market, like a period like the NASDAQ in the .com, where it took 15 years for it to recover and make new all-time highs. And so this creates this mentality that, oh, who cares if I'm down 5, 10, 15, 20%? In a month, I'll be green again and I'll be at new all-time highs. I've been around long enough. I traded through the .com, traded through 08, 09. It's not that easy. And I worry the markets are basically letting us start to believe that it is that easy. And I listen, I've thought trades were easy on my own, and those are the ones that smoke me. And I just would send that cautionary tale out to everyone that eventually we are going to get a smackdown where it doesn't recover. And the higher we go, just like a rubber band stretching, the more tight it gets. And when it finally snaps back, it could be nasty. And so I just want to caution people out there, be careful. There's nothing wrong with taking a profit, putting a little bit on the side in cash, or even looking to buy gold when it pulls back.
Yeah, Gareth, always sharp as ever. Thank you for walking us through the charts. From what you're showing, I mean, we've got a market hitting record highs on AI momentum, these flashing technical resistance, gold consolidating after that $4,300 peak, and Bitcoin testing its ceiling yet again. Appreciate this.
Hey, thank you so much for having me. It's been a pleasure.
All right. And for investors, that means discipline matters more than direction. We'll see if this AI-driven run has more fuel or if it's setting up for another shakeout. For Kitco News, I'm Jeremy Szafron. Thank you for watching. Stay tuned and hit subscribe as we track how these charts play out into November.